The sector rotation theory presented by Sam Stovall, a chief investment researcher at CFRA Research, explains how the money in the stock market moves from one industry to another based on the market anticipating future changes in the economic cycle. There are 11 stock market sectors, which are stocks grouped by similar business operations or industry and outlined by the Global Industry Classification Standard, or GICS. Knowing which stock market sectors perform best in each phase of the economic cycle, as well as having the ability to identify which market cycle we are currently in, can lead to more profitable investing. Today we're discussing what the sector rotation theory is and how to tell when it's time to rotate sectors using the market cycle, the economic cycle, and overbought or oversold cycles. Make sure you stick around till the end of the video for the 3 best sectors to be invested in now. Sector rotation was able to be theorized using the analysis of data from the National Bureau of Economic Research, or NBER. This data demonstrates that economic cycles have been fairly consistent since 1854. Because the economy generally moves in reasonably predictable cycles, the financial markets attempt to predict the state of the economy in its next phase. This means that the market cycle is always ahead of the economic cycle despite moving independently. For example, the stock market will always look ahead towards recovery while the economy is still in a recession. The stock market and its cycle can be broken down into 4 different stages. The market bottom or trough occurs when a long-term low point is reached, as stocks rally due to local low prices, a bull market is present, and a recovery is occurring. At this point, investors are excited with the market, and a market top or peak is eventually achieved, causing prices to flatten out. Disappointment then takes over, and increasing pessimism over time due to continuously dropping prices show signs of a bear market wherein a trough is reached once again. Remember, the market cycle moves independently of the economic cycle. Although the market may give you an idea of where the economy will go, there's no direct correlation present. The 4 stages of the economic cycle are a full recession or contraction, an early recovery, a late recovery or expansion, and an early recession. In a full recession, gross domestic product, or GDP, is retracting quarter over quarter, and it is a poor time for businesses and job seekers alike. At this stage, interest rates are generally falling and consumer expectations have hit rock bottom. During the early recovery, industrial production begins to grow again, and consumer expectations are rising. Likewise, interest rates have bottomed and the yield curve is beginning to steepen. In the late recovery stage, as the economic cycle begins to approach a peak, industrial production flattens out and consumer expectations begin to decline again. Interest rates may be rapidly rising while the yield curve flattens. After surpassing the peak, an early recession begins as the overall economy looks poor, industrial production is falling, and consumer expectations are at their worst. On the other hand, interest rates are at their highest and a yield curve is flat or even inverted. Once able to identify which stage of the economic cycle we are currently in, as well as using the market cycle and other signals such as GDP, interest rates, the yield curve, and consumer expectations, then we now have an idea of which sector should be the strongest in the next stage of the economic cycle. In a full recession, the sector rotation theory states that sectors such as consumer discretionary and technology will begin gaining momentum first. As it continues, the communications services sector will see increases, and industrials are estimated to perform best before the economy reaches its lowest point. This may be a little confusing, but remember, the market will always be recovering before the economy does. As the economy approaches its bottom, the market should have already begun recovering, which is why you see a sector rotation into growth opportunities. When economic recovery enters its early stages, it's theorized that you should rotate from industrials to basic materials, followed then by energy. These are more defensive sectors as the bull market begins to flatten out and a peak is on the horizon. Later in the economic recovery, the consumer staples and healthcare sectors are considered stronger investments. These companies sell products that people need no matter what as the economy is recovering. Not only will they put luxury purchasing such as cars and boats on hold to stock up on food and personal care items, but we will also see money exiting the market as the bear market begins. After the economy reaches its full potential, the following stage of the market cycle begins, predicting the early recession, sparking money to move from the healthcare to utilities sector. In addition to utilities, as the economic recession begins, the financial and real estate sectors often see higher returns. Over the next month or two, we'll be doing a deep dive on how we should expect each sector to perform given the current state of the economy. If you'd like to be notified of these uploads, please hit the subscribe button and turn on the notifications below. In addition to the market cycle and economic cycle being used as signifiers to let us know when it's time to rotate sectors, we can also use overbought and oversold cycles. These cycles occur when the market experiences a large and consistent swing in one direction, either up or down. If the market is overbought or oversold, a reversal in its trend is due, which in turn causes investors to rotate into a different sector. An overbought market occurs when prices as a whole or from a particular sector increase over an extended period of time without any notable pullback. One way to tell a stock is overbought is by looking at the relative strength index, or RSI. When a particular security or sector has an RSI above 70, it is considered to be overbought, and a reversal in its price towards the downside should be expected. From 2017 to present day, the Technology Select Sector Spider Fund, ticker XLK, has seen an incredible run-up. Even March 2020 did little to slow them down. We can learn two things from this chart. Firstly, RSI is not always a reliable signal for reversal. Notice the RSI exceeds 70 for more than a year before the largest profits are seen. This was largely due to innovations within the technology sector driving the market. Secondly, looking towards 2022, we can see XLK exceeds 70 RSI, and then the price reversal begins. On the other hand, oversold markets occur when stock prices continuously decrease without any sort of rally. If the relative strength index of a specific security or sector drops below 30, it is considered to be oversold, and you should expect prices to rise. The same 2017 to present time frame of the Energy Select Sector Spider Fund, ticker XLE, shows a much different story. This fund shows the energy sector trending down before March 2020. At this point, their RSI drops below 30 and their price begins to recover. One thing to consider here is that RSI may have just dropped below 30 as a result of the entire market dropping. Keep in mind, however, the technology sectors did not. Looking at the same two funds, XLK in blue, XLE in green, and the Spider S&P 500 ETF Trust, SPY, in red from 2020 to present, we can see a clearer picture of the possible rotation. Late December 2021 shows the Spider Technology Sector ETF reach its peak and begin to reverse downward. At the same time, we see the flat returns of the energy sector ETF gain momentum and begin to increase rapidly. Let's take a look at all 11 sectors now. Here are their returns relative to SPY over a period which is 1 quarter long, or 90 days. From April 1st to August 4th, 2020, the first quarter after the COVID crash, we see the consumer discretionary and technology sectors performing the best. Referring back to the sector rotation model shows after reaching market bottom, the technology and discretionary sectors would be most heavily invested in. Furthermore, we can note large relative losses in the later modeled sectors such as consumer staples, utilities, and financials. The next quarter, from August to December 2020, shows the discretionary and technology sectors slowing down dramatically while communication services and materials pick up. We also see quite a large increase in returns for industrials, which is still consistent with the sector rotation model. The first quarter of 2021 remains orderly with the sector rotation model too, as the energy sector sees a massive increase in returns while discretionary and technology begins to decrease more. At this point, theoretically, according to the sector rotation model, the market should begin to flatten out. But what happens? The following 90-day period shows the greatest returns from the discretionary and technology sectors, while all others lost out to SPY. This contradicts the sector rotation theory, which makes it flawed in its ability to predict which sector will perform best next. However, in the following quarter, and this is where it gets interesting, from September 2021 to the beginning of January, the energy sector beats out both the consumer discretionary and technology sectors. And again in the first quarter of 2022, although this time the relative returns look a lot more consistent with the model. Energy sees the greatest returns by extraordinary margins, implying the market has reached its peak. Additionally, we see the more defensive sectors such as consumer staples, healthcare, and utilities begin to gain traction. For the remainder of this year, quarter 2 of 2022, we also see returns we expect as the bear market begins. Staples, healthcare, and utilities have the greatest relative returns, now even beating out energy. So what does this all mean, and what are the best sectors to be invested in now before the economic cycle rotates into its next phase? Gross domestic product, as of April 2022, has yet to dip, but the rate at which it's increasing has slowed. Interest rates are also growing rapidly, and consumer expectations are continuing to decline. One of the most important signals to be able to identify a recession is the 2-10 Treasury Yield Spread, which is the difference in yields between the 10-year Treasury and 2-year Treasury notes. When this metric becomes inverted, it is historically a precursor to recessions. If you reference the sector rotation theory, and I remind you again that it is just a theory, as well as all the data that we have just covered, then the utilities, financials, and real estate sectors should be strongest in the next stage of the market. A couple things to take into consideration here are the length of the bear market. We do not know how long it will take the market to move through its separate stages of the cycle, or even if things will get sloppy, such as the technology sector did back in 2021, popping up out of nowhere again. If the bear market decreases slowly, it may take more time to see a rotation from sectors such as consumer staples and healthcare to financials and real estate. Also, keep in mind that the entire sector is generally driven by its largest and best performing stock. Looking at the relative returns of each sector the way we did using the Spider Select sector funds may make it appear like those sectors as a whole were on fire. Unfortunately, that's just not the case, and it's usually much more realistic for the few largest companies to be insanely profitable, while there are thousands of other losers. Using these Spider Select sector ETFs essentially allows us to view the top 10 holdings of each sector. This makes it an ideal way to find potential investments after finding out which stage of the economic cycle you will be in next. For example, looking at the top 10 holdings of XLE, the Spider Energy Select Sector ETF, we can see ExxonMobil, ticker XOM, and Chevron Corp, ticker CVX, are both weighted just above 20%, while the other 8 companies each account for below 5%. What would happen if we reference this data during the second quarter after the March 2020 crash, when industrials and materials were hot, and invested money into ExxonMobil before the energy sector even picked up at all? Here's the ExxonMobil stock chart from December 8th, 2020 to August 5th, 2022. Just as our data has shown, XOM had a slight increase, slowed down a bit, then began quite a large rally, more than doubling their share price over the past year and a half. With that being said, consider adding some of these tickers to your watch list, as they are some of the largest companies in the utilities, financials, and real estate sectors. Duke Energy, DUK, Berkshire Hathaway, BRKA and BRKB, JP Morgan Chase, stock ticker JPM, and American Tower, AMT. If you found this video helpful in any way, please remember to subscribe to the channel and give me a thumbs up. Let me know in the comments down below which sector you are currently weighted in the most, and if you're planning on changing this in the future. As always, I'm Patrick Zimmerman. Thank you for your time, and have a nice day.